Hello and welcome to another episode of Full Court Finance here at Zacks. Today we're taking a look at 3 beaten down tech stocks to consider buying for possible long-term upside as we start the fourth quarter. And those 3 stocks we're looking at are Uber, Pinterest, and Wix. But before we get into everything, remember to subscribe and leave a review wherever you listen to our podcast, and make sure to check out our Zacks.com/promo page for looking at some of our portfolios, services, and more. All right, so before we jump into these 3 stocks, it's worth just taking a look at where the market stands after the brutal end to the third quarter and a really bad September. Obviously, September is a historically bad month for stocks. So just to give a sense of why we might be looking at these stocks and if the market has quote unquote bottomed, we'll look at that before we jump into these 3 stocks. So we saw the market tumble earlier this week. Many were blaming that hotter than expected job openings data, but many people also started discounting that as a lagging indicator because it was from August and the numbers seemed kind of out of whack in general. So you fast forwarded to that ADP employment report from Wednesday, and that came in way cooler than expected at around 89K versus 160K estimates from Wall Street. So that was the slowest growth since January 2021. So that was September's figures. That's one of those things where now bad news is good news for the stock market. So then everyone will be looking at that Friday non-farm payroll data that will be out maybe by the time you're listening to this. And traders are still expecting the Fed to pause. This is the idea that they're going to be in wait and see mode. Everyone's talking about higher for longer, but higher for longer doesn't necessarily mean they're going to keep jacking up rates. It just means that they're going to keep them in place to fight lingering inflation as the U.S. economy remains on really stable footing, with the unemployment expected to tick down back to 3.7% from 3.8% the month before that. So overall, though, the most recent CME FedWatch tool projects about 80% chance that the Fed's going to leave its rate unchanged in November. And then the big money on Wall Street's also continuing to lean towards another pause in December, about a 63% chance of them leaving their rates unchanged. So either way, the most of the money on Wall Street saying that there's either going to be no more hikes or just one more 25 basis point hike, and then the Fed's going to have just sat on its hands for a while and then see about possibly lowering them at some point, maybe in 2024. This then has a lot of people wondering if the market bottoms in. So we saw a big jump on Wednesday as we approach that 200-day moving average. First of all, it is kind of a fool's errand to try to call an exact bottom in the moment, and they can only really be done in retrospect anyways. But buyers did step in around that 200-day moving average for the S&P 500, and we could see some more chop around in the next week until the third quarter earnings season officially begins, or I guess you could say unofficially begins next week because we've had some reports already come out. But next Friday, October 13th, is when JP Morgan and the big banks start rolling out their Q3 earnings data. So we might be sitting on our hands until then, and everyone's just hoping that the data starts confirming that the earnings outlook's continuing to hold up, because the Q2 data was great and better than expected, and the outlook for Q4 is really strong in 2024 and 2025 as well. So overall, those 2 big market moving factors, which are interest rates, we're near the end of the rate hiking cycle, barring anything getting wildly out of whack on the inflation front going forward, and the earnings outlook still looks really strong. So it'll be big to see the first part of the earnings season, and maybe investors kind of want to hold off until there. But overall, the S&P 500 has taken a big dive, which is actually kind of a positive thing after that really strong rally. So we're back to that 200-day moving average, and if we find support here and continue to move up, we could be headed for what could be a solid fourth quarter. So with that in mind, we're going to take a look at those 3 relatively beaten down tech stocks that people might want to consider buying for longer term growth upside. And the first of those 3 names is Uber Technologies, which trades under the ticker UBER. So its name, its shares have soared about 80% so far in 2023. And the ride-hailing firm in early August reported its first GAAP operating profit in company history. Wall Street celebrated its ability to expand its ride-hailing and delivery businesses while also focusing on the bottom line, which is something people kind of thought they were never going to do. But like with all these big tech companies, they have gotten forced to focus on the bottom line as interest rates rose, which is a solid thing for investors in that new environment that people actually have to focus on profits and not just spending at all costs on growth. So the company also crushed our earnings estimates and boosted their guidance last quarter. So if we look just at what they did last quarter, revenue was up 14%, which is solid, and gross bookings were up 16%. And ride hailing revenue, so they call it mobility, was up 25% in terms of gross bookings, with delivery up 12%. So it was really good to see that people are back to living their or their pre-pandemic lives. Everyone's just taking Ubers again. As I said, gross bookings are up 25%, so that's a great sign. And delivery was still up 12%. So people are using both delivery and still going out. So it's good to see that Uber's you could always call them, I guess, more affluent users are continuing to use their services, which is a great sign. And we saw monthly active platform customers climb 12% year over year and 5% quarter over quarter to about 137 million, which is a good sign. So looking ahead, we're calling for Uber's revenue to jump 17% in 2023 and then another 18% in 2024 to get all the way up to about 44 billion. So that's a great sign. And then in terms of monthly active platform customers, we're calling for an 11% growth in 2023, with trips expected to climb about 21%. So despite all of the talk of slowing consumer spending, there's still a lot of people out there who are using something like Uber for getting around and delivering food. And then the company is expected to swing from an adjusted loss of $4.65 a share all the way up to 42 cents in positive earnings, and then get all the way up to $1.08 per share in 2024. And its upbeat earnings revisions help it grab a Zacks ranked #1 strong buy at the moment. And it's crushed our earnings per share estimates in the last 3 quarters. So that's a great sign. And then moving on to just some ideas of what Uber is doing as a business. So they're focused on now, as I said, the ride hailing business and delivery business, but they're also still preparing for the future. So I'm going to kind of touch on what they've done there. So they have, during the last couple of years, during the pandemic, they bought some peers, including Drizzly and Postmates. And on top of that, they're rolling out more advertisements across their Uber platform. I don't know if anyone's a Uber user. I use Uber, I'd say about a couple times a month. And you do now see more ads popping up when you're using Uber. So it doesn't really affect you in any way, but it's something, if you're paying attention to the app, you'll see the ads pop up. So that's something they're monetizing, that core business of theirs, which is a good sign. And on top of that, they're trying to reduce errors on the delivery side and various things. As I said, they're just focusing on being as efficient as possible. But with being efficient in their core businesses, they're also still focused on the possibility of being that autonomous driving company where they're delivering food and people and transporting goods. And maybe that's going to be in 5 years, maybe it's going to be in 20 years, but that's something they're still betting on. They announced a partnership with Waymo earlier this year, and they're hoping to possibly either be competing against or alongside the likes of Tesla and others in that space down the road. So now we're going to look at some price and valuation. So Uber is up about 7% since its IPO back in 2019. This lags way behind the Zacks tech sector's 70% climb. But more recently, the stock's up about 50% in the last 12 months, and that crushes the Zacks tech sector's 28% climb, and it crushes its rival Lyft, which has fallen about 30% during that period. And this includes, as I mentioned up top, an 80% run in 2023, and it's still trading about 30% below its average Zacks price target and 10% below its 2023 highs, while hovering right around its 50-day moving average at the moment. And it's also solidly below neutral RSI levels, so it's cooled off along with most of the market recently, even though it's still up 80% this year. And then in terms of valuation, it's trading at a 65% discount to its own highs at 2.2 times forward sales and 43% below the Zacks tech sector. And its PEG ratio, which factors in longer-term bottom line growth, sits at 1.1 versus Zacks tech sector's 1.9. So a big discount there in terms of its growth-focused valuation metrics. And so longer-term investors really might want to consider Uber as it proves it can thrive in multiple key segments of the economy and become profitable at the same time. And Wall Street is pretty high in the stock. So 27 of the 33 brokerage recommendations that Zacks has are coming in at strong buys alongside 4 buys and 2 holds. So some positivity on Wall Street there. And now we're going to jump over to Pinterest, which trades on the ticker PINS. So Pins, it was a big pandemic winner alongside a lot of the digital ad focused stocks like Snap and Meta and, well, Facebook at that time. But the stock went on a huge run. This was during that post-COVID boom when everything was going up. Every tech stock was going up. It went from $15 a share at one point to nearly $85 in early 2021. And it's pretty much tumbled from its peak since then, as it was had a big pull forward, and then everyone pulled back on ad spending in general, and everyone pulled back on tech stocks. So they were a victim of just circumstances. You could say that ride up was way too overblown, and then the ride down has also been pretty blown out of proportion maybe at this point as well. So let's focus on what the company does, and then we'll look at some of the outlook for earnings and revenue. So it's kind of like a digital vision board, Pinterest. There you pin things. It became a hit with advertisers and small businesses and entrepreneurs because their content kind of fits seamlessly in there. People are going there to look for ideas of, say, some clothes to buy or how to decorate their house or where to go to eat or what vacation to go on. So paid content and advertising fits pretty much seamlessly into that platform. Unlike, say, if you go to Instagram or Facebook, you don't want to necessarily focus on the ads. You're focusing on following the people you're trying to follow or get a hold of. So they're focused on rolling out far more kind of e-commerce and shopping features beyond ads to drive that longer term engagement from users and brands. And they have a lot of users, so 465 million monthly active users, up 8% year over year, and this was last quarter. And as I mentioned, yeah, they have very unique content compared to the likes of Snapchat and Instagram and things like that. And like with everything, they're focused more heavily on the bottom line. And they had a CEO who took over from Google actually in June of 2022. And they're focusing on, once again, rolling out their kind of own unique lane in the digital advertising and digital economy. So they're boosting that as well. So they're taking steps to increase the money they're making by making it easier and more efficient for advertisers to reach their users. So all of that is a good thing going forward. In terms of revenue growth, we're calling for about 8% revenue growth this year to get up to about $3 billion. And then another 16% revenue growth next year, which is really solid to get all the way up to about $3.5 billion. And we're calling for 55% adjusted earnings growth this year, and then another 20% adjusted earnings growth nearly next year. So big top and bottom line beats both this year and next. And this would come on top of about 9% revenue growth in 2022. And then the massive stretch of growth where it did 50% growth in 2021, 50% growth in 2020, and then about 50% growth in 2019. So it's obviously slowed down heavily from there. So that's why part of the reason why Wall Street backed off the stock. But doing 8% and then another 16% growth next year is solid top line growth, especially as the company gets bigger and bigger. It's expected to do about $3.5 billion in sales next year. And its earnings revisions are trending heavily in the right direction. With them up big since their last report to help it land as Zacks ranked #1 strong buy, and its most recent quarterly estimates for its most recent estimate for its current quarter, or I should say Q3, is up 10% compared to consensus, and for 2024 it's up about 11%. So the most accurate estimates, which are the most recent earnings estimates we've gotten from analysts, are coming in solidly above their already improved earnings outlooks, which is a great sign. As I mentioned, it's a Zacks ranked #1 because of that, and its industry is sitting in a top 30% of all of our roughly 250 Zacks industries. And the company has a really strong balance sheet, which is always a great sign for, especially at the moment where everyone's worried about rising interest rates and debt. The company only has about $500 million in liabilities versus about $3.2 billion in total assets and about $2.9 billion in current assets. And they have a ton of cash and cash equivalents, about $2.3 billion in cash and equivalents on their books at the moment. So really strong balance sheet for Pinterest. The stock's up about 9% in the last year and 10% in 2023. and it's up around 30% since early May. It's gone on a pretty wild up and down ride so far this year, and it's trading about 23% below its average Zacks price target. And Wall Street's pretty high in the stock, so 13 of the 22 brokerage recommendations are coming in at strong buys, alongside no sell recommendations whatsoever. And if we look back since the company's IPO in the middle of, or actually it was April of 2019 or so, or the middle of 2019, the stock's kind of moved sideways at this point from there. Went on, as I said, in that massive post-COVID spike, and it's come back down to earth since then. So you're kind of getting in on Pinterest at a possibly enticing level. It's currently sitting in between both its 50-day and 200-day moving averages as well. Obviously, its valuation is still somewhat of a concern. So it's trading at about 5.2 times forward 12-month sales, which is solidly above the Zacks tech sector is about 3.7. So maybe if you're really concerned, obviously, about its valuation, you might not want to consider Pinterest. But longer term, maybe it's put it on your watch list if you think the value will eventually come back in line as they grow their sales and earnings at a more steady clip going forward. And the last stock we're going to look at today is Wix.com, which shows in the ticker Wix, WIX. It's a company that helps other companies build websites. So it's bolstering its website building offerings to kind of help carve out a more market share with professional site designers. It posted blowout bottom line results over the last year, including a big Q2 beat. And Wall Street developers are gravitating towards its AI-focused efforts as well, which is a good sign. So we're going to kind of jump into the business and then look ahead to what they're going to be doing on the top and bottom line and some other fundamentals. So Wix started helping small businesses and really anyone else design and maintain a website back in the mid-2000s. The company offers pretty extremely easy to use and intuitive, user-friendly tools to help customers essentially create like a DIY, do-it-yourself website through its array of offerings. The company then over the last handful of years has raced to introduce more features to help it attract professional website builders. So for instance, in 2020, the company launched Editor X, which is a platform made specifically for designers and agencies. It's then rolled out AI text creator features and a ton of more partnerships with the likes of Meta and Google. And then in July, they announced a new AI site generator and various other efforts since then that have a lot of people on Wall Street and businesses pretty excited about the possibilities of what they can do on the website design and creation side. So all of these efforts are helping it expand beyond these people who are trying to do it all on their own. So for example, its partners revenue was up 36% year over year in the second quarter versus just 13% total revenue growth. And they define a partner as any agency or freelancer that builds sites or applications for other users. So that's that kind of a look into how they're trying to expand the business. The company grew its revenue by an average of 50% between 2014 and 2018, following its 2013 IPO. It's slowed down since then. So still, though, it's posted about 28% average sales growth between 2019 and 2021. And then it slowed to just 9% in 2022, which happened to a lot of companies in the tech world. The slowing year-over-year growth, though, is somewhat natural, as it grew from about $200 million in sales in 2015 to $1.4 billion last year. With the fading top-line expansion in the end of zero interest rates, the company has started cutting back on costs and focusing on the bottom line and profitable expansion. So in streamlining various things, that's kind of just the theme amid all businesses, but especially the tech companies. And they said earlier this year they're trying to achieve the, quote, rule of 40 by 2025. And that's the idea that its combined growth rate with profit margin should exceed 40%. And as I mentioned, the company crushed our Q2 earnings estimates. It was up, they crushed by 133% in early August for its fourth straight triple-digit beat. And looking ahead, Zacks estimates are calling for it to swing from an adjusted loss of 17 cents per share last year all the way up to $3.35 per share in 2023 on 12% stronger sales. And then it's expected to expand its sales by another roughly 12% next year and boost its bottom line by about 5% as well. And it's really upbeat earnings revisions has it landing a Zacks rank number one, a strong buy like all of its companions on our list today. And now we're going to close out with some price and valuation efforts from the stock. So Wix shares have climbed about 450% since their market debut. That crushes the Zacks tech sector. Despite that run, it's now down about 14% in the last 5 years to trade around its COVID sell-off lows and roughly 70% below its highs. It has, though, been on a bit of a comeback trail, so it's up about 40% since last June, and it's still trading 15% below its 52-week highs and 35% below its average Zacks price target. On the technical front, it's sitting currently in between its 50-day and 200-day, but it is possibly set to test that 200-day moving average, so some investors might want to hold off until we see how it interacts with those levels. But on the valuation front, it's trading at 2.9 times forward 12-month sales, which marks a solid discount to the Zacks tech sector and 44% value versus its own historic median. And it's currently trading at 26.4 times forward 12-month earnings to roughly match its industry. So overall, it appears to be taking advantage of the ability to grow on the AI-focused business side, which is everything that they're talking about these days in the world of tech. So trying to become more profitable and get into a new segment of the website design and building world. And Wall Street's pretty high on the stock. So 10 of the 16 brokerage recommendations we have are strong buys, alongside 2 more buys and no sells. So overall, Wix, along with Pinterest and Uber, are certainly worth considering if you're a longer-term investor looking to maybe cash in and buy a home run style play. None of these are obviously nothing on Wall Street's surefire, but these are certainly more home run plays that you might want to consider buying as we start the fourth quarter, especially if we see the market continue to trend in the right direction. And maybe we have bottomed after a really downbeat end of the summer and start of the fall months here. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.